In this video, we're going to look at how you can use a testamentary trust to minimize your tax and protect your assets for future generations. Hey, it's Nick Talevsky here from Talevsky Partners, where we help business owners and professionals build their business, minimize their tax, and grow their wealth. When it comes to making out a will, generally it is made along the following lines. Everything I own is to go to my partner, B, and should they die before me or at the same time as me, then everything is to go to our children, being C. The partner then writes a similar will in favour of the first person, being A. This is what's known as a standard will, but unfortunately it is not tax effective and provides no asset protection. This is because the assets are passed on to an individual, which means they are solely responsible for the tax on the income that is received. Also, if the person receiving the inheritance goes bankrupt or gets divorced, the assets can be taken from them. Another popular but little known strategy is for the deceased to leave their assets in what's called a testamentary trust upon their death. In this case, A leaves the assets in the testamentary trust with B and C as the beneficiaries. B is nominated as the trustee of the trust, and upon their death, it is predetermined that C becomes the trustee. C then controls the assets, so then B and then C have control of the trust. Let's now take a look at the advantages of this structure. A testamentary trust allows the person who controls it to split the income generated by the trust between family members. Importantly, children who receive income from a testamentary trust are taxed at adult tax rates. This means that children can enjoy the tax-free threshold and receive up to $18,200 from the trust without paying any tax. Let's look at an example. Let's say the wife dies, leaving a husband with 3 children. The wife's asset comprise of the family home and a life insurance policy, which is valued at $2 million. The husband is a business owner and earns $250,000 per annum. So any further income received by him will be taxed at the highest marginal tax rate, currently 45% plus Medicare levy of 2%. So if the husband were to earn returns of $120,000 on the investment, he would pay tax of $56,400. Now, let's take a look at the situation with a testamentary trust. In this case, the wife's will creates a testamentary trust, which is then controlled by the husband. The $2 million is placed into the testamentary trust, and that $2 million is then invested and produces the same return of $120,000 annually. The income is then distributed in accordance with the following table, equally to the children at $40,000 each, and the tax payable would only be $13,641. This simple case study illustrates that by using a testamentary trust, just in year 1 alone, the husband is able to save $42,759. Over a 5-year period, and ignoring the effects of compounding, the total savings will be over $213,795. It's important to note that funds in a testamentary trust that are distributed to children do not need to be paid to those children and can be used for things such as the children's school fees, clothing, medical expenses, healthcare, and all of the other needs for the children. The other major benefit of a testamentary trust is asset protection, because the assets in the testamentary trust do not belong to the beneficiaries of the trust, but are simply controlled by those beneficiaries. They are not subject to the risks associated with the beneficiaries, such as litigation, creditors, or bankruptcy. Taking the example set out above, the husband is a business owner and his business is struggling to pay its debts. The husband is being sued by all of his business partners and the tax office. The tax office and the partners are aware of the $2 million life insurance policy over his wife. Unfortunately for the partners in the tax office, those proceeds do not belong to the husband and instead form a part of the testamentary trust. Therefore, the partners in the tax office are unable to access those funds, and those funds will remain protected and in the family. Testamentary trusts can also be used to provide protection if any of the beneficiaries divorce. By careful planning of the terms of the testamentary trust and ensuring the testamentary trust is established in the right way, it can be much more difficult for a disgruntled spouse to access funds left to a beneficiary via a testamentary trust. This is an excellent way of protecting the wealth you pass on to your children in the event of them getting a divorce. Testamentary trusts can also provide ongoing protection for young children, vulnerable, or disabled beneficiaries. You can decide who will manage the testamentary trust on behalf of the beneficiary, and if appropriate, at what age beneficiary should take control of the trust. Finally, testamentary trusts can provide you with the opportunity to reduce the 17% tax payable on taxable superannuation proceeds paid to non-dependent children. For example, if the husband did not have a testamentary trust and when he died, he had $500,000 in taxable superannuation which got paid directly to his non-dependent children, they would pay tax of 17% or $85,000. However, with a testamentary trust, the tax could potentially be reduced to zero. In summary, a standard will gives you no tax advantages and does not provide asset protection in the event of divorce or creditor attack for the next generation. It also leaves you vulnerable to death tax on your super if your children are no longer dependents. Setting up a 3-generation testamentary trust overcomes these issues and provides you with complete flexibility, which is the most important thing when it comes to estate planning. So why is flexibility so important? It's because we don't know, 1, when we will die, 2, what assets we will have when we die, and 3, what the tax laws will be at that time. A testamentary trust gives you asset protection by ensuring the value of assets remain in the family bloodline and can only be passed on to your children and grandchildren. Plus, as a bonus, it significantly improves the taxation position. If you would like to set up a testamentary trust or review your situation, we invite you to book now for a complimentary consultation to discuss your needs. As estate planning specialists, we are qualified to develop a comprehensive estate plan for you, including setting up your wills, enduring, and medical power of attorney. Our aim is to give you peace of mind that your estate is protected for future generations. Until next time.